PayPal is down around 50% over the last 5 years, and today we want to understand if this is one of the most undervalued stocks in the market right now. It does currently trade for a forward P of around 14.58, and we have a double buy rating seeking alpha as well as from Wall Street. So we're going to do a deep dive of this company. We're also going to take a look at some of their statistics, understand their market share, as well as looking at their latest investor presentation to understand their forward guidance for the next full year. We're also going to look at the underlying metrics, their free cash flow, the ROIC, their debt levels. We want to understand the numbers behind this company, as well as what insiders have been doing, any buys, any sells, and the same analysis for the institutions, whether we can see a general theme going on here. And as always, we will do a deep dive. We want to take a look at the top line revenue growth as well as the bottom line net income, understand whether there are any trends. Is this a company that continues to grow year on year? And the same analysis, but on the balance sheet, a quick health check, total cash versus total debt. Now, don't forget, we will conclude very importantly with the valuation model. We'll get to our intrinsic value, get to our acceptable buy price, given our investor margin of safety, and look towards Wall Street to see what they're forecasting over the next 12 months. So the first thing we want to highlight your attention to are some key facts from this company, and in fact the main one that we did find really interesting is that PayPal currently holds around 45% of the global payments market share, and therefore what this means, it is the number one payment processor globally. Now maybe this is something you did know, but again we did find it very interesting and we thought we would bring it to your attention, as well as the fact they have 60% of consumers say that they trust PayPal more than their bank for storing payment credentials. Again, this is from 2024, so the latest statistic, and they have 426 million active users, and payment volume reached around 1.5 trillion in Q4 of 2023. So this is a massive company, something just to understand before we take a look at the deep dive, because a lot of people do believe that PayPal is on its way out. And another interesting thing that we can see here in terms of the merchants that use PayPal, they exclaim here over 165 countries worldwide. It is growing at over 10% over the last 5 years. So again, it is not just the number one payment processor globally used by many merchants, but is growing consistently over the last 5 years as well as historically. Now, in terms of some of the numbers, very quickly then, it is down 50% as we mentioned over the last 5 years. When you look at it over the last 10 years, you can in fact see it did peak around summer 2021 over $300, and year to date it is down around 3%. In terms of the 52-week range, well, it is trading in the mid to lower end of this, and unfortunately for those like myself that do love dividends, they don't currently pay one, and the market cap sits around 63 billion. So let's take a look at some of their numbers. As always, top line revenue, we want to see consistent growth, 3 to 7% at a bare minimum as a baseline metric. 8 billion in 2014 as their top line, 30 billion or just under in 2023. So we're seeing nearly 4 times growth over the last 10 years. And what is beautiful to see here is that consistent growth year on year. And that is one of the main things that we do want to see with companies we invest in. We'll also look at that percentage growth later on in the episode. And in terms of the story to be told on the bottom line net income, 419 million in 2014, 4.2 billion in that latest annual report. So again, very nice growth. Top line nearly 4 times, bottom line more than 10 times growth to their net income. And whilst we do see nice growth over the longer term, we do see some inconsistent growth from around 2019 to 2023, so just the last 5 years. Nonetheless, it is still looking very strong, and it is overall, when we zoom out, moving in the right direction. Now, how does this compare to their health? Well, total cash short-term investments has grown massively, 2.2 billion in 2014, 14.3 billion in their latest quarterly report. And again, we can see here over the longer term, PayPal's cash position has increased very, very dramatically. We are talking about around 7 times over the last 10 years. As always, that number really means nothing unless we do compare it, and we are looking at it versus the total debt numerically and historically, which, as we can see, likewise to the cash, has grown from 1.1 billion to around 11.7 billion. And again, over longer term, we do see that increasing trend. Now, something that we will keep an eye out for, given that this has grown around 10 billion over the last 10 years, Nevertheless, though, the balance sheet is looking very strong, and that 11.7 billion, when we do compare it to that essential cash balance, we can in fact see it is sitting higher at 14.3. So if PayPal wanted to, it wouldn't even take them one day to pay off all of their debt net of cash on hand. Now, earnings estimates, how have they performed? Well, over the last 4 quarters, very mixed. In fact, the first one that we see, Q2 of 23, it was in line. Subsequent to, they did beat, but in their more recent earnings, they did miss. So we would say ultimately they beat 50% of the time over the last 4 quarters, although 3 of the last 4 they did have at a minimum in line with analyst targets. Now, looking forwards, we do note some unfortunate news here. They are anticipating negative double-digit growth to their earnings per share over the next 3 quarters. Q1, though, we can see very minimal low single-digit growth, 1.67%. When we look forwards to that earnings per share December 2025, we do get that forward P around 13, again, based on if they do meet that, and as we can see, they have meet or beat at least 75% of the last 4 quarters. So interesting to know, always can include that within your own investment thesis as well, something I do quite like to take a look at. Now, in terms of the metrics, first one, we're going to look at the valuation. They get a D+. In terms of the P on a non-GAAP basis, main reason, well, 14.58, but what we do see here, the sector is significantly lower, so you are paying a premium of 41.48% for PayPal, but as always, do bear in mind it could be justified, as we may uncover throughout the episode. Now, in terms of other metrics, depending on which ones you use, they do have some very good numbers, but also some very poor. For example, on a price to cash flow, they are trading at around a 10% discount to the sector, or if you do in fact do a price to book on a forward-looking basis, they are in fact trading at a premium of 181%. Again, depending on which metrics you do use, that information is there for full transparency. We then take a look at the growth grade. Now, they get a C+, as we can clearly see here. In terms of why that is, well, 8.39% in terms of revenue year-on-year growth, better than the sector of 4.54, and also we can see very similar forward-looking 8%, whereas the sector median single mid-digit at 5.12. The other thing that we quite like to see, and unfortunately for PayPal they do suffer, earnings per share over the next 3 to 5 years, they are anticipating 8.58%, whereas the sector median 9.62 is higher, and in fact not only are you paying a premium for PayPal to the sector median, but they're anticipating around 11% lower than the sector median in terms of earnings per share numbers. How about in terms of profitability? Well, they do get an A, so gross profit margin actually pretty poor, 39%, with the sector median around 60%. Bottom line as well, pretty poor, 14.26%, sector median 23.1%. But if you do look at the other metrics like the ROCE, return on common equity, as well as the return on total capital, it is much better, hence the A and B+, as well as the cash from operations, 5.6 billion versus 160 million as the sector median. Now, to wrap up this part of the analysis, a double buy rating with a hold from quant, D+ on the valuation, C+ on growth, A from profitability. Remember, again, always come to your own conclusions whether or not you believe this valuation element is justified. How have they compared against others in the financial sector? We have Fidelity, Aiden, Block, Pfizer, Global Payments, some very big names. In fact, we have covered the majority of these on our channel. Over the last 12 months, PayPal down 14%. They're not the worst performing, but what this goes to show you as a whole, the majority of the sector has been hit very, very hard. When we expand it over the last 5 years, we do note a very similar story, with 4 of them negative, with only 2 positive. We see Aiden as well as Pfizer. When we expand this over the last 10 years, what we do note, even though PayPal is up 71%, it is one of the worst performing, and ultimately 71% over a 10-year period is a pretty poor return on any investment. As always though, past performance is not an indicator of future performance, just something that we like to see. They could perform a lot worse in fact, or they could ultimately perform much, much better. Now, a lot of people on the channel do like to buy individual stocks, but I would ask, only invest, in my opinion, if you are thinking that this company will outperform the S&P over the next 10 years and beyond. We can look for now with the data we have at the historical performance. Over the last 12 months, well, PayPal has severely underperformed the S&P, negative 13 with the S&P up 25%. Over the last 5 years, we see a very similar story. PayPal down negative S&P up positive, and over the last 10 years, even though PayPal is up 72%, the S&P has far outperformed. Now, obviously, it is important to understand that PayPal may have an incredibly strong next 10 to 20 years, but always factor this into your investment decision. Make it one of the questions you ask yourself: do I see this company outperforming the S&P? If not, why not look at a low-cost ETF for the S&P like VO? Now, before we do jump into some of these metrics, just to let you know, we have released our latest free weekly article. If you want access to this or any other articles, all completely free, do click on that pinned comment below. For example, if you want to see how to find undervalued stocks, we run through all the screeners that we have to identify these companies. Or if you want to see the latest 12 undervalued high quality stocks, you can click on that article straight away. It is free to use. Now, insider ownership, pretty low, 0.14%, 5.21 million worth of sales by the insiders over the last 12 months. 5 different insiders. In fact, the more recent quarter, 273,000 worth of sales. Quarter 1, more selling. Quarter 4, again, more selling. But then Q3, Q2, very minimal. Now, who are these insiders that are selling? So we have Deborah M., the director, the more recent one, 24th of May, selling over 4,400 shares. In fact, the share price marginally higher than it is now, $272,000. We have the SVP, Frank Keller, on the 1st of March, sell over 7,600 shares. Again, just under $500,000. Whether you want to incorporate this, it's completely up to you. For me, 1, it is a little bit outdated, and 2, the amounts are fairly trivial. And also, do bear in mind, insider selling, but you don't know why they sell. It could be personal or financial reason. Institutional ownership, 68%, 7.2 billion worth of sales by the institutions over the last 12 months. A lot more buying, in fact, 3 times as much, 22 billion. However, what we should point out, in the more recent quarter, 690 million worth of sales versus 552 million worth of buys. So yes, over the last 12 months, institutions have been buying more, but in the more recent quarter, they haven't been in fact selling, although marginally more than they have been buying. But as always, more important than any of this information, always do your own due diligence. Don't copy what these institutions or insiders do. Let's take a look at the latest investor presentation update. Now, a few things to note. In terms of growth, total payment volume up double digit, nice to see it 14%, as well as their revenue year-on-year growth, nice high single digit, although we will look at this shortly for the last 10 years. In terms of the numbers, now 2 things we always want to see with companies. We want to see increasing revenues, but ultimately something that maybe people don't think about, we always want to see increasing margins as well. Whether that's their transaction margin, their operating income margin, we always want to see this increase year on year, ideally quarter on quarter as well. Now, in terms of their revenue, what we do note, over the longer term, it has been increasing, but we can see quarter 1 has dipped lower than quarter 4 2023, although this could be due to seasonality, as quarter 1 23 is lower than quarter 1 24. In terms of their operating margin as well, we do see it very inconsistent, although when we do zoom out over the longer term, it has increased, and the same is to be said as well for the earnings per share. So a little bit of inconsistency there that has been noted. And when we look at the free cash flow, something we ultimately do focus quite heavily on this channel, 76% up from the previous year, adjusted around 86%. Now, that is great to hear. We do love increasing free cash flows, and we will expand this to see the last 10 years. But ultimately, from looking at their investor presentation, not seeing the growth from the last 5 years at a minimum, it is very hard to deduce whether or not this is something consistent for this company. Finally, then, when looking at their next quarter guidance, they are estimating around low double-digit growth to the EPS. When we look at the full year guidance for EPS, they're anticipating mid to high single digit growth. When we look at their revenue for the next quarter, 6.5%. And one thing that we will incorporate into our valuation P, free cash flow for next year at 5 billion. And also something that maybe have gone under your radar, they have repurchased quite a significant number of shares over the last year, and they're anticipating this to be at least 5 billion for the full year of 2024. Now, quite importantly, with free cash flow, as we mentioned, we want increasing free cash flow over the longer term. That is something we do know with PayPal, but what we can also see, it is inconsistent on a year-on-year basis. Nice to know over the next 12 months, they are anticipating some very strong growth to this number. Sales growth, as always, 3 to 7% is what we want to see. Double digit though from PayPal. One thing that we can clearly see, it has started to slow down from double digit to high single digit. 2024, they do expect this to be fairly similar as well. So maybe this is something to incorporate into your own valuation, that their sales growth, their top line increase that they have historically seen, is starting to slow down, and another format to what we saw in terms of the sales. It is looking very nice and consistent on a year-on-year basis. Shares outstanding then, what we always love to see, returning excess cash to investor pockets. It is something PayPal have done over the long term, although in terms of a more consistent basis, we haven't seen that quite yet. Nice to note though that they are continuing to do this for the full year of 2024, down to around 1.09 currently as we speak. ROIC, as always, we want to see a minimum of 10% to give us faith management are able to effectively allocate their capital, and we can clearly see that as well as increasing over the longer term. I do love the consistency that we are seeing here. Operating margin, well, speaking of consistency, we want a minimum of 16%, which is pretty much what we see over the longer term. Very consistent, very minimal movement. Ideally, we would have wanted to see some operating efficiency and increases over the longer term. Free cash flow as well, very inconsistent, minimum of 7%, which we do see, but year on year the numbers do move quite significantly. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization, shows us the strength of the balance sheet. These are ultimately the number of years it would take the company to pay off all of their debt net of cash on hand. For the majority of the last 10 years, it's zero across the board. Over the next 12 months, zero as well, meaning it won't even take PayPal one day to pay off all of their debt net of cash on hand. Let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Graham's valuation first, stock ticker symbol, earnings per share, long-term growth rate, AAA corporate bond yield, and what we get is an intrinsic value showing undervaluation, although we want to point out two things. It is fairly marginal, so you could argue reasonable valuation, and the second thing to note is that we're not looking at any one of these models in isolation. We then move on to the multiples valuation model, companies in a similar sector and size, their PE, the average PE multiplied by the EPS of PayPal, and we do see in fact an overvaluation signal, which no surprises here, PayPal does look to be trading at a higher forward PE than the rest of the sector, as we did look when we were looking at the valuation PE. Now, typically we would run a company through the DDM model. They don't currently pay a dividend, so this one is irrelevant for now. DCF model, we have the free cash flow year on year, average growth rate 20%. Forward looking, we have gone very, very conservative at 5%. With a discount rate, we do get the present value of future free cash flows and terminal value. Do bear in mind we are using 5 billion as that is what they're expecting for 2024. Add all this together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we have a strong undervaluation consideration here. The intrinsic value in today's episode is the average of these three models that we have just gone through, coming to a total of $72.33. Bear in mind as well, you can grab a copy of this model to get to both intrinsic and acceptable buy price for companies in your own portfolio, that on your watch list, or if you just want to run through PayPal based on your own numbers. Margin of safety then, 10%. As always, we execute on this if it meets our three golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that for PayPal, well, it is a buy up to $65. Then we keep going till it's near the current trading price, and what we see, it isn't at a 20% margin of safety just yet, but it is sitting between 15 to 20%. Now for me personally, this does look like a very strong value play as well, but 15% margin of safety is a little bit too little for what I am looking over the longer term. Ideally, I would like to see this at a 25%, around $54, and it was there not too long ago, so for me, this is a serious consideration if it does come to around $55 and below, which maybe we will see in the not too distant future. So currently 15 to 20% MOS level. In terms of Wall Street, well, they see upside of 26%. Their price target is $74.55. A little bit higher than our intrinsic value, but they do consider this one as for the portfolio if you do believe in this company over the longer term. As always though, do let us know your thoughts in the comments below. Is this one you're looking to add? Maybe it's on your watch list, or for whatever reason, it isn't one that interests you. As always, have a great day. See you on the next one, and take care for now.